Hey guys, hope you are all having a fantastic day. Today's video was meant to come out yesterday, but given Jerome Powell was due to speak this morning, I decided to wait so we can cover the different things he said. It is no doubt the market has been getting clapped for months, and uncertainty rules now stronger than ever before, and yet, stocks have been rising lately. On my last video, I alluded to the probability of markets running up before the next big reversal, and I believe that is what is happening. But there are some important and significant changes that we need to address, because they will impact market sentiment for months to come, and my goal in this video is to give you a broad set of data so that you can be better prepared for what is to come. We are going to cover a lot, and much of the data will be frustrating, so buckle up, but before we begin, I want to take a quick moment to hype up my Discord. Guys, these past couple of days, the market has been absolute trash. If you are a day trader, you know better than anyone how choppy things have been, with poor market direction and sentiment changing on the daily. And even then, we have been making an absolute killing. Look through our performance, we are nailing all our alerts, coming in green consistently. If you need a strong guide that alerts to clear entry and exits with strong guidance through each play, join the Discord, tag me in the Hangouts channel and say you want access to day trades. It's that easy. Now, let's talk about some market news. Fed Chairman Jerome "The Joke" Powell emphasized the need for the central bank to be free of political influence while it tackles the persistent high inflation that has crushed the middle and lower classes. As CNBC reported, in a speech delivered to Sweden's Riksbank, Powell noted that stabilizing prices requires making tough decisions that can be unpopular politically. He said, and I quote, "Price stability is the bedrock of a healthy economy and provides the public with immeasurable benefits over time. But restoring price stability when inflation is high can require measures that are not popular in the short term as we raise interest rates to slow the economy. The absence of direct political control over our decisions allows us to take these necessary measures without considering short-term political factors." The speech did not contain any direct clues about where policy is headed for a Fed that raised interest rates 7 times in 2022. Stocks rose today, though it was clear that there are worries about a more aggressive Fed. Right now, the big question lies on how much will the Fed raise rates this year. Because nobody has a clear idea what, it brings uncertainty which in turn yields in this weird sideways market that makes no sense. Investors did not react well to recent comments from the Atlanta Fed President Raphael Bostic and San Francisco Fed President Mary Daly. Both of them detailed expectation for interest rates to rise above 5% or 3/4 of a percentage point from current levels, which indicates a lot more pain is to come for stocks. This is the exact same thing we talked about on our last video last week. There will be more pains, but the stock market and investors continue to stubbornly want to pump markets in the false beliefs that the bottom is in, that nothing can go wrong and things can't get any worse, which is untrue as I am about to provide various examples of, but before that, let's clarify what Fed Governor Michelle Bowman had to say. The governor said the central bank has more work to do to curb inflation, noting that further interest rate increases are needed and officials should hold them at restrictive levels for some time to stabilize prices, which is key. She mentioned, and I quote, "In recent months, we have seen a decline in some measures of inflation, but we have a lot more work to do, so I expect the Fed will continue raising interest rates to tighten monetary policy, as we stated after our December meeting. Policymakers are driving home the message that they aren't done tightening policy as they work to squash inflation that rose to a 4-decade high last year." Officials unanimously approved a half-point hike in December, which brought the target on their benchmark rate to a range of 4.25% and 4.5%. Bowman also said the scale of future rate moves and the point at which officials stop hiking will be determined by what happens with inflation, adding that she wants to see compelling signs that inflation has peaked and is looking for consistent evidence that is on a downward path. The Fed governor made it clear that policymakers expect to hold interest rates at higher levels for a while, allowing time for their aggressive increases to work their way through the economy, slowing growth and creating better balance between supply and demand. She said it is likely the labor market will weaken as inflation comes down. So here you have various individuals involved in the making of monetary policy literally telling the world that the Fed needs and is expect to continue tightening down, yet the absurdity of the market has resolved to simply begin pumping stocks up for no apparent reason. It seems as if everyone is scared to not have priced in the bottom and are in a rush to move everything to the moon. The counter to this is that, as I have explained before, the higher and higher stocks go, the harder it will be for the Fed to tame inflation, which means they can only get more and more aggressive as bulls pump things up. Market bulls believe that nothing can cause price uncertainty and that the bottom is in. I disagree, and so should you if you are level-headed thinking. The world is in full disarray. If you weren't aware, things are about to go from bad to worse in Ukraine. According to some sources, Russia is planning to add an additional 500,000 soldiers to the fronts as a way to push back Ukrainian forces. This means this conflict is set to last for more than a year, and given the eased nature by which Russia has talked about using a tactical nuclear deterrent force as a means to win the war, it will have awful tension on the markets for however long this conflict lasts. We are seeing a lot of instability in Brazil now, with many people storming government buildings as a protest against election results. Brazil is a key exporter of many goods, and this type of event makes them come off as unstable to the rest of the world, which adds further instability. If these things aren't enough, it appears that China is conducting more drills around Taiwan, escalating tensions of what could possibly become another war. These are the big in-your-face things that are making markets unstable, but let's also talk about some of the lesser-known ones. We have seen crypto rise to such magnitudes that ETFs have been created following the coins. Because of the large exposure the stock markets now have with crypto, it makes us vulnerable to whatever events are happening. We have seen the disgraceful FTX fall from grace, Coinbase stock plummet, and now, there are mounting fears that Binance, the world's leading crypto exchange, could be in trouble. Binance acknowledged that its finance-pegged BUSD stablecoin is not so stable after all, because it apparently hasn't always been backed fully with reserved. The token was at times under-collateralized in 2020 and 2021. A spokesperson told Bloomberg the process of maintaining the peg involves many teams and has not always been flawless, which may have resulted in operational delays in the past. Federal prosecutors are examining American hedge funds dealing with the cryptocurrency exchange as part of a long-running investigation into potential violations of money laundering. In subpoenas sent in recent months, the U.S. Attorney's Office for the Western District of Washington directed investment firms to hand over records of their communications with Binance. Even further, a day ago, a Forbes article came out with news stating that Binance has been bleeding assets, more than $12 billion gone in less than 60 days. The outflow of cash has been much worse than the CEO of Binance has indicated and made believe, which at best put the reputation and confidence of crypto in question and at worst could see another significant portion of crypto market valuations erase. As you all may know by now, we have been living through a recession for years now, but the corporate media shills and the rest of the world love to pretend we aren't in one yet, but that does not mean they aren't warning about an incoming start of a recession. The World Bank recently cut their 2023 forecasts and warned of a global recession. It's kind of hard for me to comprehend what they mean by global recession when America has the best standing economy right now, whereas everything else is severely suffering for the most part. Europe's economy is just down the toilet at the moment with the energy crisis they are dealing with, along with the uncertainty of Russian provocation and escalation of war. China's economy keeps stumbling, and there will be a huge change of fortunes as more companies depart from China and look at other countries to continue means of production. China has proven to be unstable, and companies do not want to continue forsaking their own well-being on a country that continuously has lockdowns. Regardless, the World Bank is warning that new adverse shocks could top the global economy into a recession. The global gross domestic product will probably increase 1.7% this year, about half the pace forecast in June. That would put it to be the third worst performance in the last 3 decades, after the contractions of 2009 and 2020. The bank cut its growth estimates for the year 2024 as well, and said that persistent inflation and higher interest rates are among the key reasons, while also citing the impact of the Russia invasion of Ukraine. The crisis-facing development is intensifying, not easing off. And now, Congress is set to vote on a bill abolishing the IRS completely and eliminating income tax. Now, this bill is believed to have been made in order to make sound and not really go through, but effects of these things mount on top of each other. All these things create for a volatile and unstable environment for markets to make true progress and find strong footing, because everything is always shifting. One big set of news that mostly went unheard or underappreciated was the Swiss National Bank reporting a loss of 132 billion Swiss francs, or $143 billion, for their 2022 financial year, citing preliminary figures. This represents the biggest loss in the central bank's 116-year history and equates to roughly 18% of Switzerland's projected gross domestic product of 744.5 billion Swiss francs. For consideration, their previous record loss was 23 billion francs back in 2015. The Swiss bank will not make its usual payouts to the Swiss government and member states, with payments to its shareholders also set to be affected. Of the losses, 131 billion francs came from its foreign currency positions and 1 billion from its Swiss franc positions amid strong gains made by the franc as investors flocked to the perceived safe haven. This is a huge deal. We are looking at one of the most stable and strongest safe havens in the world reporting historic losses, greater than anything ever before, and yet as I look at today's market performance, everything gives the impression as if things are improving. So, with all these relevant information before us, what can we expect from the future? It is hard to tell with any degree of certainty, because the markets are irrational and incredibly optimistic, even down to where we are overall. I think positive results from the CPI on Thursday have a strong chance of pumping the markets, given many investors believe that a strong CPI along with the very bullish results from economic data we received last Friday guarantees path towards stocks moving up. However, this rationale does not make sense to me, and the reason for this is that CP data is affecting the markets strongly because of the expectation of what these results will have on Fed decisions. CPI could be perceived as a lagging indicator of economic performance, given that it informs us of inflation that occurred the previous month. This information is used by the Fed to make decisions on whether to pivot or to continue being hawkish. As I mentioned in the very beginning of this video with evidence from multiple Fed officials, they are all aggressively hawkish. They do not like the data they are seeing, and even with improving CPI reports, they believe they need to continue hiking up rates over and over until they see various economic feedback from multiple sources suggesting things are cooling down and that they are finally back in control. As such, even with lower than expected CPI report, we could see the stock market quickly have a bull rally, but even then, in the longer time frame, could see it weakening and retesting recent lows. A higher than expected CPI will have very detrimental effects on the stock market, forcing huge pullbacks across entire sectors. The economy in the world is in tatters, the Fed is incredibly hawkish and doesn't seem to want to pivot, a soft landing is becoming harder to believe in day after day, the economy is resting on unreliable and shaky foundations that can shift again and send us down a slippery slope, and even the banks around the world are telling people bad things are to come this year. Don't believe the daily charts, we are in a deep recession. The market is incredibly weak. We saw this exact scenario play out not once, but twice last year, where market bulls were so assured that the dip they endured was the bottom, only to months down the road be slapped with a reality check with a dip making a new bottom. As I have said, it's impossible to time the bottom, there are too many things at stake all playing at once. In a bear market, it is better to buy in late than to buy in early. Once we begin to see strong data suggesting strength in the economy, then we will reassess our stance. Until then, anyone bullish is simply so because they are shooting darts in the dark hoping to catch that home run. Few will be right from luck, and the rest will be wrong. Stay focused. Let's see what the CPI report says. We could see SPY go above $400 again with a real good inflation numbers showing improvement, and simultaneously, we could see a pump and dump. Anything and everything is on the table as we speak. Do not commit your heart and mind to only one perspective, but rather, stay open-minded and neutral. I am not a perma-bear, I am a realist. Last Friday's economic data was bullish and the sentiment turned bullish for a while. Good CPI will add to that sentiment, which can carry us up for a while. Or then again, depending on what the Fed says, it might now. The Fed and their stance is what matters most right now, and a bad CPI will all but settle the debate that the Fed needs to be more aggressive, and then we could see a huge dip. I have another video for you guys later this week in regards to AMC. In it, I will talk about the possibility of the company getting acquired and why the acquisition thesis is making more and more sense as AMC continues to depreciate. Thank you for watching this video. I will see you on the next one, to the moon.